Very privileged having Greg Ramsby. Went to Oglethorpe University and Notre Dame for an MBA, and has been in the asset management equity institutional side for quite a while, and he joined DePrince Race and Zolo in 1996, which is a institutional equity shop in Orlando, in 1996, and he's now a partner and portfolio manager. And like everybody, he would like to answer your questions more than go on and on, so anytime, early and often, questions are welcome. Thank you.
Thank you, Dr. Brown, and thanks for having me. Thanks everybody for coming today. I'm going to spend a few minutes showing you a little bit of a unique style of equity investing, one that's worked for our firm for over 25 years. I'd like to emphasize, though, that it's just one way of approaching the equity market. It's not the right way. There are several different ways that work very well, I'm sure, but this is one that's worked for us, and it's unique. So I'm gonna walk you through it. So who is DePrince Race and Zolo? We're based in Winter Park, Florida, which is in the Orlando area. It's an institutional asset management firm, which is different than what you might think of. There are two real parts to asset management. There's what I call the retail side and the institutional side. And the retail side would be high net worth, mutual funds, things like that, where the clientele is usually an individual. And on the institutional side, we manage money for no individuals. All of the money we manage is either Fortune 500 pension money, foundation money, endowments, things like that. So this firm was founded in '95 by three gentlemen who were the managing directors of Sunbank Capital Management in Orlando. And they wanted to move away from the retail or mutual fund side of the business and focus exclusively on the institutional side of the business. And so they founded their own firm. Kind of sounds like a law firm, DePrince Race and Zolo, in 1995. It's 100% independently owned by the 6 partners, of which I'm one. 40 employees. One of our partners, who's in charge of our marketing function, Kelly Carbone, is a 1986 graduate of the University of Florida and a huge Gator fan. Total firm assets before the illustrious third quarter, which was down about 20%, was almost $7 billion. And you can see the 7 products that we offer and the various assets under management we have in each of these products. I mentioned 25 years of history. That's in our large cap value product. I'm responsible for managing our small cap and micro cap products. Those 3, large, small, and micro, is sort of the foundation of our firm right now. You can see it's close to 100% of our assets under management. These other 4 products, SMID, international, global, emerging markets, are our future growth areas and are relatively new. You can see we're not running much money there. In fact, global and emerging markets are less than a year old. But all of these products use the same methodology, the same investment discipline that I will walk you through in a minute. Also, in my team, we're in the process of launching an ultra microcap product, which I was just meeting with the, what do you call it, UFICO, the head of your investment corporation here that manages your endowment, on this product this morning. Here's a list of, or a representative list of some of our clients. As I said before, these are mostly corporate or municipal pension plans or they could be college endowments, or they could be hospital, healthcare type pension plans. Some of the bigger ones on here, UPS is the largest client we have in our microcap fund. Many of these clients, including Houston Municipal Employees Pension, have been with us since before we started our firm, meaning they came from the other firm and have been with us ever since then. In fact, the gentleman who's running your UFICO used to be the head of the Houston Municipal Employees Pension Plan and hired us to run money in several different products about 20 years ago. So that's an overview of who we run money for. And here's the real meat of the presentation and how we run money, how it's unique, and how it works for us. This is what we call short duration equity investing, to steal a fixed income term. And it's short duration in the sense that we are taking a component of our return stream and getting it today, guaranteed in cash. And I'll show you in a minute how much of your return that has been over time, how significant that is. But just on this short duration idea, the way we run money, being short, what we call short duration equity investors, would be the opposite of something like Google, which I would call a long duration equity security where there's no dividend, so there's no return of cash to shareholders at all. Trades at a very, very high multiple that's based on some expectation of future growth, and unless that growth is sustained, that multiple is going to contract. It'd be kind of the polar opposite of the way we run money. But as you can see here, everything revolves in our process around dividends, which have several merits. Down market protection. We've seen that very clearly in the last 3 months, and also very clearly at the end of 2008. It's the stocks like Google, the ones that are trading at the higher multiples, that are more speculative kind of names, that would get hit the hardest typically when the market goes down, and the dividend payers would hold up better. Dividends provide a meaningful portion of the market's total return. As you'll see in a minute, it's in many cases 50% of your total return. Do you want me to stop and ask as I go along, or? No, he's got a question here. Okay, I'm just saying, I think not a lot of people are aware of it, but over long periods of time, the return stream from dividends has accounted for as much as 50% of the total returns from the stock market. So the implied question to me is, why would you not want to pay a dividend, or why would you not want to own dividend-paying stocks if half of your return comes from that over long periods of time? Go ahead.
I was going to ask, you said you're in the process of launching the micro-cap fund.
Right.
How long, I'm just curious what goes behind the scenes in launching a fund like that? You can talk about it.
Sure, yeah. I talked a little bit about this at lunch with some of the students. I run a microcap fund that focuses on an area of the stock market that we define as below 500 million in market cap. And for a long time, we were only running $50 or $100 million in that fund. And in the last 18 months, we raised about $400 million and closed the product. So we have about $500 million. And what happens when you're running that much money in an illiquid part of the market is there's the very bottom end of that market cap range. So from 150 million to zero. We can't really get in and out of those stocks anymore. And so there's a part of our space that we're not able to invest in anymore. Behind the scenes to your question, that happens to be the most inefficient part of the U.S. equity market, and we don't want to ignore it. So We started, actually, the genesis of it was client-driven. Somebody asked us, well, have you ever thought about running a limited capacity ultra microcap fund? And so we started looking into it, and really I think the critical issue is behind the scenes we did what's called back testing. So if you just take that whole universe and equally weight every stock and just back test it over time to see how it does against certain indexes or other products you might have, and the numbers were extremely compelling. And since it was a client-driven request and a lot of these stocks are companies we were already familiar with, we didn't necessarily need to move up any sort of learning curve or do a whole bunch of new research. So we're kicking it off right now, and that's what I was meeting with UFICO about today. And there's a few clients that are interested in it, but it's, if you like, we can talk more about it later. It's a fascinating part of the U.S. equity market. There's virtually no Wall Street involvement at all. Most of the largest shareholders of these companies are the CEO and his wife or his family's trust or something like that. So it's a different kind of equity research and a different kind of company, and just an inefficient part of the market that we didn't want to leave untouched. In microcap or ultra micro? Oh, ultra micro. Yeah, we think we can run only about $75 or $100 million. Versus, we're running $500 million in micro, which is the next step up on the market cap spectrum, and then we're running $1.5 billion in small cap. And those are the three that I'm responsible for. And when you get down, obviously the biggest caveat when you get down into that space is liquidity. And so you can only run a limited amount of money. But given the inefficiencies, we think it's worth it. So we'll talk more in a second about how significant a portion of your total return comes from dividends. We also, prospect of lower absolute returns increases the appeal of higher yielding stocks. What that's referencing is up until about 2 years ago, you had an extended period of time in the U.S. equity markets where the average annual returns were way above normal, and that usually is not very sustainable. You're seeing the unsustainable side of that right now, which enhances the appeal of stocks that provide you income today. Dividend yield offers concrete evidence of real earnings. This is a somewhat of a foreign concept to some people, but we view it as the most reliable valuation measure from the perspective of it's the only valuation measure that can't be managed or is not subject to accounting changes. If somebody pays you $1 worth of dividends, that's what you're going to get. If you're looking at some other valuation measure like PE, price to cash flow, price to sales, there are various ways that you can manipulate those numbers or that they can be changed using different accounting standards. One very simple example that comes to my mind is the way people value REITs, which are real estate investment trusts. When I started 15 years ago, people used to value REITs on price to cash flow and just add back the depreciation of the asset. Then they wanted to use what they called funds from operations, or FFO. Now they want to use adjusted FFO, or they want to use NAV or adjusted NAV. It seems to me like you're changing a valuation parameter to suit your purpose. That's impossible to do with dividends. If you commit to it, it is what it is. So it's a very reliable valuation measure. So our strategy in a nutshell is to look at undervalued stocks with above average dividend yields that possess some sort of fundamental catalyst. And by that we mean, we're typically looking at these down and out cheap stocks that have these big dividends, and unless there's something changing inside the business, something that's improving for the better, then chances are that down and out cheap stock is going to remain a down and out cheap stock. It got that cheap for a reason. Something's wrong in the business. So what we do, and I have 5 analysts that work on my team, and what they do is what we call bottom-up fundamental research to try and identify these catalysts or these changes that are taking place. And it could be a new product cycle. It could be some sort of a restructuring that's going to dramatically improve the profitability or the cash flow. It could be using your excess cash flow to deleverage your balance sheet, raise your dividend, buy back your stock. It could be a new management team, or it could be a new strategy or a change in strategy, something that's inherent, or something that's inside of that business that's changing, that we can quantify, that we think is going to cause the market to take this down and out cheap stock and revalue it higher. But it's got to have some sort of fundamental change for the positive behind it. And so you tie this all together, you hear the argument a lot of, well, if I pay a dividend, doesn't that mean my earnings are going to grow slower because I'm not pouring all my money back into reinvesting in the business? And what you'll find is that the opposite is actually true, that those companies that have the highest return on capital or the most consistent earnings growth are those companies that have a balance between how much they invest internally and what they share with their shareholders. And what we're saying here is if you have a healthy balance between the two, it forces a management team to be even more diligent with their return on capital because they don't have as big a pool of money to play with, because they're giving it some of it to you every quarter in the form of a dividend. And these would be, if you look, some of the academic research has suggested that those that have a nice balance between investing internally and paying dividends are the most efficient users of shareholder capital. Contrary to what you might think about pouring money, needing all that money to grow. So let's talk about the total return. This is what I was referencing earlier. This goes back only to 1990, so 21 years, but you can take this analysis all the way back to 1930, and you'll see fairly similar numbers. This is looking at large cap stocks. And what you see on the left is if you're a large cap value investor like our large cap fund, 51% of your total return, the blue bar on the far left, 51% of that came from dividends. If you bought non-dividend paying stocks, you got the green bar. On the growth side, dividends are typically a much less prominent priority, but in this case, they're still almost a third of your returns, large cap growth. So it begs the question again, you sure you want to buy non-dividend paying stocks? Over the last 20 years in U.S. large cap, you would have paid a big price for doing so. Oh, and one thing I neglected to mention too, before I get farther, those 7 products that I mentioned earlier, we have minimum dividend yields for each of them. But in this case, our large cap value fund, which is about a $4 billion fund, has a dividend yield of about 3.25%, which is right now in excess of what you'll get from a 10-year treasury. So that's another part of the unique part of the way we run money. On the next page is our small cap, which is what I'm responsible for. We have also about a 3.25% dividend yield on this fund. And you can see here, slightly lower, but still 40% of your returns In the Russell 2000 value came from dividends. This is since the inception of the Russell indexes, which was 18 years ago. Much smaller number in small cap growth, but still 15% of your total return. And then have some of the other funds in here too. Sorry, go ahead.
I just want to make sure what this graph assumes that the dividends are reinvested.
No, I do not think they are reinvested. It would be paid out in cash, I'm pretty sure. Yeah. Well, there are dramatic differences. There's no guarantee of anything from a buyback. That's the negative. The other negative is companies usually their timing of the buybacks is usually very poor. One thing that comes to my mind is if you go back to 2008 when the stock market went down 30% in 1 month in October of 2008. If you looked at aggregate stock repurchases in the U.S. equity market, going up to that point, they were following the market. It was like a straight line up. And then the market went down 30%, and the buybacks went straight down. Okay, I would have thought that you would have seen the complete opposite. When the market went straight down, the buyback should have gone straight up. So I think it sends a positive signal to investors that, you think your stock's cheap. You might not have better places to put your money. I get all that. It's obviously usually has a positive influence on the stock price, usually accretive to earnings. But it's not a portion of your total return, and there's no guarantee. And usually it's poorly executed or not executed at all. A lot of times, I'm not saying this is the reason why companies announce it, but a lot of times you get an effect on your stock price just by announcing it, and then you don't do anything. You can't do that with your dividend. You can't say, I'm going to pay you this, and just not pay it. So hopefully, does that answer your question? Okay. Actually, what we like to see in an ideal world is companies taking their excess cash and doing a combination of paying dividends, raising dividends, buying back stock when the timing and the valuation is right, and paying down debt. All of those are typically constructive for equity prices and multiples. So what I was saying here is you can take this dividend philosophy and you can move out of the U.S. equity market and look internationally, and you see an even larger percentage. And this goes all the way back to 1969. Almost 60% of the return from stocks in the EFA index comes from dividends. And you can see the massive difference between just price appreciation and total return. Probably the one that surprises me personally the most, we just started an emerging markets fund about 9 months ago. And it's only got about, I think, 15 or 20 million in assets, but it's got a dividend yield of 6%, which is highly unusual and very counterintuitive to me. But you can see here that even in the emerging markets, so even in the fastest growing parts of the world, China, Brazil, wherever you're looking, wherever's growing the fastest, where you would think companies are plowing all that money back into growth and not paying dividends, incorrect. 50% of your return from dividends since 1987. So, somebody asked me that, one of the students asked me that at lunch, and I don't know this market very well, but I would guess that you just have a lot of overcapitalized companies, and they are, or maybe the philosophy about dividends is different. Right. Yeah, I think maybe there's that you've got something there that something inherent in the philosophical way these companies are run that says we should share some of our excess cash with our shareholders, which obviously I would agree with. So now let's look at. I hope you guys can read this. The right. Oh, okay, you can see it here. So does this stuff really work, or are we just playing around down there in Orlando? Not only does it work, but it highlights something that I think is probably the biggest strength of the way we run money. You're always taught as an investor, or most people are taught, that the more risk you take, the higher the reward. So risk equals reward. What I'm going to show you in this chart is higher returns from dividend-paying stocks. This goes back to 1972. So dramatically higher dividends versus non-dividends. But what's really the critical point here is you're getting more return by taking less risk. And I'm defining risk in this case by annualized standard deviation. And you can see it's dramatically lower for dividend payers than non-dividend payers. So what we refer to that as superior risk-adjusted returns. You're getting better returns by taking less risk, which is somewhat counterintuitive to what we've learned over the years. Another important point, when you're managing pension money like we are, and these companies have employees retiring, and they're paying out money from their pension plan to those employees, this lower volatility is a really attractive feature because you could have a flood of, say, baby boomers that are retiring in a short period of time. And if you get into a period of a bad market and you have really negative volatility, those balances are getting hit really hard right before they're taking their money out. So for the pension community, in an ideal world, you'd want less fluctuation, obviously, particularly on the downside. Sure. Right. Yeah, well, I think the swings in the volatility in the growth stocks is much greater because of the because of the difference in expectations and because of the difference in the kind of investor that it attracts. Typically, those are maybe earnings momentum type of people. I mean, you saw this with the tech bubble about 10 years ago, where Yahoo, and you remember all these Netscape and all these companies that went public that had no earnings, minimal cash flow, and they're being valued in the market at $10 billion when they're worth essentially nothing today. That's the difference. I think a different kind of investor and a different kind of expectations. So this next, this next slide, is really just showing you that it's not just in one year or in one kind of market that dividend payers outperform non-dividend payers. It's 65% of the last 37 years, so 24 of the last 37 years. And if you notice, if you look at the chart carefully, there's not one period of time where the non-payers beat the payers for more than 2 years consecutively. And lo and behold, the one that jumps out at me, the biggest bar there, where the payers beat the non-payers, was what we just talked about, the tech bubble. In 99, 98, 99, 2000. Here's a graph that shows what I was talking about before with regard to volatility. Dividend-paying stocks tend to have lower volatility, lower standard deviations, better balance sheets, better cash flow, or at least more consistent. You can see that's pretty true consistently over, it goes back to 76. We've talked about downside risk protection. In fact, 2 of the 3 products that I manage, the microcap and the potential ultra microcap product, are going to produce most of the alpha or excess return over their history in down markets, and are managed specifically to do that. So, for example, the third quarter that just ended a week ago, the Russell 2000 value was down something like 19% in 3 months. And our microcap product was 500 basis points better than that. Over a 3-month period, we produced 500 basis points of alpha. That's the strength of what we do. And just try and keep up in the up markets and produce significant and consistent alpha in declining markets. I think that's pretty much what's that showing. So last slide, and then I'll open it up to if anybody has any other questions. How's it worked? We could go farther out in large cap value. We could go to 25 years, but we have 15 years of history in small and large, net of our fees. We've done very well. Where we've done particularly well in my area is over the last 5 years, which includes the big sell-off at the end of 2008 and the big sell-off more recently. You can see the small and micro areas have done about 500 basis points better than the index every year for the last 5 years. And then longer term, you can see it in all of our products, at least the 4 main products. So again, it's one way of running money. It's not it's not the answer for everybody, but it works for us. And as I was encouraging many of the students at lunch, they were asking me, if you could leave us with one piece of advice, what would it be? And I said, figure out what your passion is, and once you do that, once you start interviewing or interning or trying to find a job, try and find out what the strategy or the discipline that the company uses that you're interested in. Using this as an analogy, the discipline of the way we run money is the key. It's why we're successful, it's why I love doing it, and it's why this firm has a bright future. Wherever you go, if you find something that's your passion, make sure you're in the right place and that they have the strategy that you think gives you a competitive advantage or a niche, which is what this is, to excel. And then if you can do that, and if you can accomplish finding something that's going, using the right strategy and going into the areas you want to go into, then the rest of it's just all up to you. But if you're not in the right place or the right strategy or the right firm, then you've got a whole myriad of other issues that you got to deal with. And it's kind of a simplistic analysis, but it's worked for me. Any questions? Yes, a familiar face. Kylie. because I think a lot of it is about perception. When people think of dividend-paying stocks normally, and I don't know how many people are like that in this room, but mostly they think of like utilities or REITs or food companies or something that's slower growing, that doesn't need the capital because they can't grow fast anyway, so therefore they pay it out as a dividend. I think those perceptions are starting to change, but I think there's been this perception in corporate finance or certainly in the U.S. equity market that if you want to grow faster than everybody else, don't pay a dividend. But look around you now and look at the companies that are the so-called growth companies. Who pays a dividend? Microsoft, Intel, Hewlett-Packard, Applied Materials. Historically never paid a dividend. Now all of a sudden they're not only paying dividends, but they're raising them every year, and these are 2 to 3% yields. So does that mean that these companies are slower growing now because they're paying dividends? No. To me, it means they're being better stewards with their capital. And I guess I didn't really, I think it's just a misperception that's existed for a long period of time where people always wanted to favor growth over income. And they thought, well, you're just more like the bond market if you're focusing on income, and that's not what I want. I want the go-go tech stocks, and the data certainly don't support that. So.
It seemed pretty evident that your investment policy adheres itself to the downturn markets. The 500 basis point return is astronomical, but
Right.
what if you see an extended period of robust growth? Why don't you jump on board and reappropriate to growth stocks when you feel that you have the opportunity to key in on that 30% excess return on non-dividend?
Because I don't need to. I'll give you an example. 2009. Okay, the market went down 35%. 2008, we did great, as you would expect. So what did we do in 2009? You had huge outside return in the equity markets in 2009, big snapback. Small cap market was up 30%. My small cap value fund, full of stodgy old big dividend paying companies, went up 50%. Beat the market by 2,000 basis points in an up market. I don't need to change. I won't beat it every year if the market's going straight up, but I'll beat it in some, and I'll beat it by enough when it goes down that I don't need to. And frankly, I can't be all things to all people. I only know one discipline. That's what people hire us for. If I were to change that, I'd get fired immediately. Well, what if you're wrong?
Yeah, well, even if, first of all, I have a bias, and if I want to hire a market time, I'll hire a market time. I don't want somebody who has this disciplined dividend approach. I understand what you do.
Right.
I get it, I can follow it, I know when you're going to do well, when you're going to do bad, I know you're going to grind out return. But then if you say, well, that worked for a while, now I'm a market timer, that's horrible. That's changing your strike.
Yeah.
Discipline.
Well, and typically, I mentioned, just use UPS as an example, one of my biggest clients. UPS has hired me specifically, or DePrince, Race, and Zolo specifically, to be their microcap value manager. They know what they should expect from us. They have taken some of their other pension money and they've gone out and hired a microcap growth manager who specializes in that. So it's up to UPS. If they think the market's going to go straight up, maybe they'll take some money away from me and give it to their growth guy. But they don't want me, losing the dividend philosophy and trying to buy tech stocks or something, or buy something on earnings momentum. They'll pay somebody else whose expertise that is to do that.
How many of your clients are tax exempt, and how do you deal with the extra taxes with dividend and capital gains?
Yeah, Dr. Brown actually emailed me a question about taxes, and all of these pension plans are tax exempt. All of them. Yeah, yeah. Foundations, endowments, everybody's got their own little tax break. I'm sorry, what was the rest of your question?
That was pretty much it. If you have all tax exempt,
Yeah, it's you know, we've gotten this question a lot from potential clients. Well, what if I have tax consequences, or what if the tax rate on dividends goes back up? And strangely enough, before the Bush administration lowered capital gains and dividends taxes, and the dividends were taxed at your ordinary income, which was, you know, somewhere in the 30s probably, we saw no benefit, no tangible benefit that we could identify from lowering the tax rate on dividends from 35 or 30 to 15. So to me, that almost says people view taxes as a sunk cost that you can't avoid, whether it's 30 or 15. The difference isn't going to make me run out and buy a dividend-paying stock per se. But yeah, most of our, for all of our clients at this particular firm, there's no tax consequences. Yeah, that's a good question. You can look at, you can break down like large cap or small cap stocks by what they call quintiles. So yield quintiles, which would be the highest yielding stocks, which let's just say would be over, say, 6%. And then the fourth quintile might be 4 to 6. And then the third quintile might be 3 to 4, and then all the way down. And what you'll find is over long periods of time that the highest yielding stocks are not the best performing. For intuitive reasons, really. Typically, if something's yielding 6 or 7% and it's not a utility or a REIT or something like that, it's a troubled security, and it's used to yield 3% and now it yields 6%. What you'll find is that in general terms, the best performing within the dividend payers are those kind of right in the middle. So paying more than just a token dividend, like a penny, like some people do, because there are some money managers that have criteria that say, I can't buy anything that doesn't pay a dividend, so they'll pay a penny. So all of a sudden they're in their universe. But you're not getting any income, and you're not getting any of the other characteristics, the downside protection, the less volatility. You need to get into a dividend that has a little bit more teeth to it, and that's generally speaking in that 2 to 3% range, which is probably the third or second quintile, which is over periods of time, at least in small cap, probably in large too. That's generally the range that does the best within the dividend payers.
Right now, many large corporations are sitting on lots of money on their balance sheets. Do you think that these companies are being prudent, given the economic times, or are they just want to sit on the cash and not return it for whatever reason?
Yeah, I think, I'm not sure prudence is the word I would use. I think it's cautious. I think the biggest reason why they're sitting on cash is because they have no visibility. I was saying in the lunch that I was on the phone with the CEO the other day, and I asked him to give me his best guess at the first half of 2012. Because people in my position are always, everything's always forward looking. You're always trying to be out in front of Wall Street and to see what's coming 1 quarter, 2 quarters from now, and take advantage of that before other people do. And I think what's happening right now in corporate America is, well, it's a lingering effect from 2008, which people spent the last 2 years after that big downturn in the economy at the end of 2008 being more cautious, deleveraging their balance sheet, raising capital. Now all that stuff's sitting on their balance sheet in the form of cash, as you pointed out. And I think they're just cautious. Is it prudent? That's hard to say. Because because you'd have to know more than I know about their businesses to say that. But I think it's part of the reason why the economy's slow. It's one of those incremental factors that slows the economy when people aren't hiring workers or people aren't spending CapEx dollars to build a new factory or buy new equipment or whatever. I think it's just all a sense of cautiousness. I think it's human nature. I think it spells for a lot of investors opportunities to find, if you look at, for example, small cap stocks today, in aggregate, almost 20% of the market capitalization of all small cap stocks is cash. It's never been that high. Does that mean that these companies are really smart and that it should be that high? I don't know. I mean, I used the example before of people tend to buy back their stock at the most expensive valuations. You're at a much cheaper valuation now, so maybe they should start, using some of that in a more proactive manner. I think what it's going to lead to eventually is you're going to see a surge in M&A, mergers and acquisitions, takeovers. You're going to see a surge in buybacks. You're going to see, and you already are seeing, a surge in dividend payers and people raising dividends. And I think it's just people reacting to the economy and being cautious. And I think those that are the best companies, you'll find out 3 years from now who that was for what they did when times weren't good. What they did with their cash, what they did with their margins, what they did for preparing for the future. Uh-huh.
Are they necessarily going to be somebody like to own when they're are there other factors that come into play?
You mean like if I own it in small cap and then it does really well and now it's a large cap stock, would we buy it in a large cap fund? Yeah, it would. It's certainly a possibility. It's happened before. Sometimes, over time, companies' market capitalization grows for a lot of reasons. Sometimes they issue stock to pay for an acquisition, and therefore they're getting bigger, or maybe they just appreciate it over time. But we would view it no differently in large cap than we did in small cap. It'd have to meet all of our criteria and just be evaluated on its own, no differently. Right. The criteria we use is in our large cap value fund, it has to have a dividend yield that's greater than the yield of the S&P 500, which today I think is around 2% or maybe just below that. But we use something different in small micro and ultra micro. We use an absolute yield, a minimum dividend yield that every security has to have of at least 1%. And we did that for a couple of reasons. Number one, the yield on the small cap benchmarks is never as great as it is on the large cap benchmarks. But number two, we wanted, if we're going to be buying dividend paying small cap or micro cap or ultra micro cap stocks, we want the dividends to have teeth. In other words, people really have to appreciate and want the dividend to buy that stock, or one of the reasons. And so we set a 1% minimum, which, just so you know, it surprises people when you say, how many stocks are there below $2 billion in market cap that pay a 1% yield? I've had people say, what is there, like 5 companies in your universe? And there's 1,100 stocks in that universe, and that's from $2 billion to 0. So some of those are in micro, but so it's 1% minimum. But as I mentioned earlier, our fund has always historically yielded much more than that. It's got about a 3.25% dividend yield right now. Yeah, that's a good. For anything to get into our portfolio, it has to meet 3 criteria. One is the market cap and dividend, which we've talked about. 2, it's got to be at the very low end or the cheap end of its 10 years of historical relative valuation, which when I say relative valuation, I mean, I use this example with the students, Cracker Barrel relative to every other small cap stock. I'm looking at its PE, forward PE, relative to the market, which I would call the Russell 2000 or the Russell 2000 value or whatever you want to. And I'd want Cracker Barrel's forward PE to be as small or as cheap relative to the market as it's been in 10 years before I would buy it. So I'm already buying something that I think, you use the term intrinsic valuation, I would say normalized valuation, same thing. And so by our nature, we're looking at stocks that are always, we're buying stocks that are always what we think below what they're worth. Anybody else? Sure. The catalyst. Right. Yeah, the first 2 are somewhat quantitative. I mean, we can use a valuation screen and a quantitative screen. Yeah, the role of the analyst in our firm, and this is what we call bottom-up fundamental research, where you're starting at the company level, doing fundamental research. You've already identified, of those 1,100 stocks in your universe, which are the cheapest. So you've got a subset of that 1,100 that you can focus on. And that's what the analysts in our firm do. They call the companies, they talk to the CEO, they meet with them in person, they dig into their fundamentals, and they build models, and they project those fundamentals forward. And we make certain assumptions and quantify certain things, and that's pretty much the role of the analyst, is digging into these businesses that are not in good shape or have stalled for some reason. That's why the stock became so cheap. Trying to find something that's going to improve and be able to quantify that both in order of magnitude and in timing via the model and via conversations with management. And we've got to have that to be able to buy the stock. Otherwise, you're buying what people call value traps, which is a cheap stock that's going to stay cheap. And it's got no reason to outperform the index or any of the other smaller microcap stocks. And the important point of their job, too, is not only doing that at the onset, but doing it throughout the what we call ongoing maintenance research, which is when you own it, you got to be continuously updating it to make sure that nothing's changing and it's not becoming less viable, or the timing isn't pushed out too far, or whatever. No, the realization of this, or the sale, is driven by relative valuation. So we want to buy, if this is somebody's chart, you want to buy it down here and you want to sell it typically in the middle of its 10-year historic range. And then at that point, we're kind of turning it over to the growth guys, because things have gotten better and maybe there's a little momentum, and we let them take that risk from there going forward. It's just driven by valuation. Now, one way we will sell it is if we're wrong on the catalyst, either on the order of magnitude or the timing. So, for example, if I bought Cracker Barrel today and my catalyst was a surge in traffic that's going to lead to accelerating same-store sales and better margins based on X, Y, and Z, and that doesn't happen, or that gets pushed back to 2013 or something like that, then you've got a cheap stock that nobody's got any reason to want to buy, and it's going to stay that way. And we would just sell it and revisit it again as it got closer to that time frame.
As far as your analysts actually talking to CEOs at companies which are valued on the bottom of the spectrum,
Mm-hmm.
it seems kind of obvious to me that it'd be harder to get in touch with CEOs in large cap all the way down to the small cap being the easiest to get in touch with. Is that true?
Well, in terms of getting in touch with, I think it's harder probably in large cap because there's so many different sources of information, and there's so many different people doing large cap. What happens when you get down, the more you go down the market cap spectrum, the more generally these companies are willing to talk to you, because they want you to buy their stock. They want you to buy 1 million shares of their stock, obviously. Particularly as you get even further down and you get into micro or ultra micro. And we were talking about this at lunch as well, where typically the largest shareholder is the family that controls the business. And they're public for a reason. It's their ultimate exit strategy, right? They're either going to sell their stock to the public in an equity offering, or they're going to sell the whole company to another company. But they love talking to us. They want us to buy their stock. They want us to understand their story. It's just a totally different animal in large cap, where if you're talking about Intel, you've got 40 analysts on Wall Street following the same company. They're all publishing reports that you can read at any day you want. It's much more efficient and much more harder to find something that somebody else doesn't know or approach it from an angle that somebody else isn't coming from. So as you go down the market cap spectrum, you have way less Wall Street involvement, therefore way more inefficiencies, more opportunities if you're an analyst to uncover things that somebody else might not be paying attention to. Yeah, there's some Elliott Spitzer boundaries is what there are. There's something called Reg FD that came out about 6 or 7 years ago. If you guys remember when Elliott Spitzer was doing whatever he was doing, he said basically you cannot get on the phone with like I couldn't call the CEO of UPS and say, how's your quarter? Are you gonna hit Wall Street's expectations? Are you gonna beat them, or are you gonna miss them? For the first 10 years of my career, I could do that, and he would say yes or no. And it was just, you had to make the effort to do it. Spitzer came out and put out this thing called Reg FD, which says you can't tell one shareholder something that isn't public knowledge, or something that you don't put out a press release on, a public press release. So what that's caused people like us that make a lot of assumptions about what the business is going to do in the future, and we need some guidance, is you have to dance around it a little bit. And there are ethical gray areas. If you wanted to be unethical, you could very easily, you could say, hey, it's just you and I on the phone. I'm not going to tell anybody. You know, what are your earnings going to be this year? You quickly, I think, would get in trouble doing that, though. So what we do is we generally tend to focus more on what our assumptions are. Instead of asking direct questions, I'll say something like, hey, I've got your top line your revenues doing this, and sort of trending this way. Is that a reasonable assumption, or is that way off mark, or is it in the ballpark, and sort of tiptoe around it like that, which it just makes our job a little bit harder. What it creates, as you can imagine, is a lot more earnings surprises, both to the positive and the negative, because it hasn't been communicated like it used to be. That's why you get more wild swings on either the upside or the downside when somebody really beats a number or misses a number. So you can thank Elliot for that. Well, that's a good question. We use a relative valuation model, like I mentioned, and what we do is we take those 1,100 stocks and we rank them from 1 to 10. This is a model on a software or a software provider called FactSet. So we can get a score from 1 to 10 for forward earnings, price to cash flow, price to book value, and dividend yield. And so I can look at that model at any point in time and say, these stock, if it's a 1, it's as cheap as it's ever been relative to the small cap market over the last 10 years. If it's a 10, it's the opposite. So this is a strange market. If you had asked me this 3 months ago, I would have given you a completely different answer. A lot of the defensive stocks, utilities, healthcare, consumer staples like food companies, things like that, are starting to look more expensive because they've held up so much better than the market over the last several months. In some cases, they haven't gone down at all, and the market's gone down 20%. And so this whole situation has been reversed, but now some of the cyclical stocks, which would be the industrials, the chemicals, the papers, machinery companies, some of the technology companies, energy's not there yet. So there's been a flip-flop in my universe of anything that was cyclical that was doing so well when the market was going straight up in 2009, 2010, and part of this year is now starting to look cheap again, and all the defensive stuff is starting to look expensive. Yeah, you could say a dividend increase, a dividend cut, certainly not. I wouldn't want to buy anybody for that reason. Dividend increase can be a catalyst, but it's probably not enough on its own for me to want to buy something. I'd need something that's more fundamental in the business. But tying that into one of my sort of pet peeves or favorite catalysts and favorite things to see in a public company is what they do with their excess cash flow. We call it free cash flow in the business, and you can create your own catalysts by what you do with your free cash flow. And I'm talking about the cash that's left over after you've funded all your CapEx, paid your dividend, met all your debt payment, everything, what's left over. And that's usually the money that people use to buy back stock, pay down debt, do acquisitions. All of those things in aggregate and combination can be catalysts that are really powerful. Because you could have bought something for a fundamental improvement story, and then all of a sudden they start throwing off cash flow, and you've got that catalyst too. So you have both. You have the business getting better and deserving a better valuation, and then you have the company using the cash flow to, deleverage their balance sheet, raise the dividend, buy back stock. All of those things are generally positive for the stock, and it's sort of the icing on the cake, if you know what I mean. Yeah, we do not do much of that. I'm a big believer that there's nobody that can consistently tell you, even 30 minutes from now, if we were in the middle of a trading day, there's nobody that can consistently tell you 30 minutes from now, is this stock going to be cheaper or more expensive? I don't know. Unless you know something that I don't, which means there's some news coming out or something like that. But we have to be, our clients pay us to be small cap equity managers, so I have to be fully invested at all times, meaning I have in my contracts, we can't go over 5% cash in the portfolio because they don't want me to be their money market manager. So I tend to just want to get the trade done as you know, efficiently as I can. Did I see somebody up here? Oh, okay. Thanks a lot.